Credit cards are not just tools for making purchases. They are fundamental instruments in building and maintaining a strong credit profile. Understanding how credit cards contribute to your credit score is essential for anyone aiming to build long-term financial health. Credit plays a significant role in our lives, from renting an apartment, buying a car, to securing a mortgage or a small business loan. At the core of creditworthiness is your credit report, maintained by credit bureaus like Equifax, Experian, and TransUnion. This report includes your payment history, types of credit used, the length of your credit history, and more. Using credit cards responsibly can boost your FICO score, the credit scoring model most commonly used by lenders. A good credit score can lower your interest rate on loans and provide access to premium financial products. But credit cards can also hurt your score if misused. This duality makes understanding their role crucial. How credit cards work. A credit card is a revolving credit account, meaning you can borrow money up to a set credit limit and repay it over time. Each month, you're required to make at least the minimum payment, though paying your full statement balance is ideal. When you open a credit card, the issuer reports your account activity to credit bureaus. These reports include your account age, payment history, and credit utilization, factors that directly impact your credit score. Timely payments and keeping your balances low relative to your limit help build strong credit. If you miss payments or carry high balances, it can negatively affect your FICO score. High credit card interest on unpaid balances can also trap you in a cycle of debt. This highlights the importance of financial literacy when managing revolving credit. The 5 key credit score factors and how credit cards affect them. 1. Payment history, 35%, the most influential factor. Consistently making on-time payments on your credit card helps build a positive payment history. Even one missed payment can damage your credit score significantly. 2. Credit utilization, 30%. This refers to how much of your available credit you're using. Ideally, you should keep your utilization below 30% and under 10% for optimal impact. For example, if your credit limit is $5,000, try not to carry a balance over $500. 3. Length of credit history, 15%. The longer you keep your credit card accounts open, the better for your credit profile. Closing old accounts can shorten your average account age, which may lower your score. 4. Credit mix, 10%. A combination of credit types, such as credit cards, installment loans, and retail accounts, can improve your credit score. Credit cards, as part of a healthy credit mix, demonstrate your ability to manage different forms of debt. 5. New credit and inquiries, 10%. Each time you apply for a new credit card, a hard inquiry is recorded. Too many inquiries in a short time can lower your score. However, opening a new account can also increase your overall available credit, helping with utilization. Secured versus unsecured credit cards. For individuals new to credit or those rebuilding after financial hardship, secured credit cards offer a starting point. These require a refundable deposit that serves as your credit limit. Over time, responsible use can lead to an upgrade to an unsecured card. Unsecured credit cards don't require a deposit and offer better rewards, higher limits, and more benefits. However, they also demand greater responsibility. Whether you use a secured or unsecured card, the key to credit building is consistent, responsible credit use. How credit card rewards affect financial behavior. Many credit cards offer incentives like cashback, travel points, or other rewards. While these features are attractive, it's important not to overspend just to earn rewards. Interest charges on carried balances can easily outweigh the value of these perks. Understanding how to leverage credit card rewards responsibly is part of advanced credit management. When used strategically, paying your statement balance in full and taking advantage of sign-up bonuses, rewards cards can be both beneficial and profitable. Balance transfers and their role in managing credit. Balance transfer credit cards allow users to move existing high-interest debt to a new card with a lower or 0% introductory APR. This strategy can be useful in reducing interest costs and accelerating debt payoff. However, it's crucial to read the terms carefully. Many cards charge a balance transfer fee and require repayment within the promotional period. Used wisely, a balance transfer can be a tool for credit repair and improving credit utilization. The connection between credit cards and interest rates. Interest rates, or APR, annual percentage rate, determine how much you'll pay on carried balances. Your credit score heavily influences the APR you're offered. A higher credit score can qualify you for lower interest rates, saving you thousands over time. Paying only the credit card minimum payment each month results in long-term interest accumulation. Ideally, cardholders should aim to pay their full balance to avoid interest altogether and to keep a clean credit history. Monitoring and managing credit responsibly. Credit monitoring services help you keep track of your credit report and score, often alerting you to suspicious activity or unauthorized credit inquiries. Many credit cards offer free credit score tracking as a built-in feature. You can also request a free credit report from each major credit bureau once a year via annual credit report. Kumul. Reviewing your report helps ensure accuracy and protects against identity theft or reporting errors. A credit freeze, though not directly tied to credit building, can prevent fraudulent activity by blocking new credit accounts from being opened in your name. It's a useful tool in identity protection. Avoiding common credit card mistakes. 1. Late payments. Even a single missed payment can result in penalty APRs, late fees, and a major credit score drop. 2. High balances. Carrying a high balance close to your credit limit negatively affects your utilization ratio. 3. Closing old accounts. Closing your oldest cards can shorten your credit history and increase utilization. 4. Applying too often. Each application creates a hard inquiry. Multiple applications can hurt your score temporarily. 5. Not reviewing statements. Failing to monitor statements may result in unnoticed fraud or billing errors. Avoiding these mistakes is critical to building and maintaining a healthy credit profile. How to increase your credit score using credit cards. 1. Always pay on time. Automate payments if needed. 2. Keep balances low relative to your credit limit. 3. Don't close old accounts unless necessary. 4. Ask for credit limit increases to lower utilization. 5. Use multiple cards responsibly to diversify credit mix. These actions not only help you increase your credit score, but also position you for better financial opportunities like mortgage approval or business financing. Debt-to-income ratio and its influence on credit decisions. While not part of your credit score, your debt-to-income ratio plays a role in lender decisions. A high ratio may indicate you're overextended and impact your ability to qualify for new credit. Keeping credit card debt low helps maintain a healthy DTI ratio, which can be especially important for major financial goals. Credit counseling and professional help. If you're overwhelmed by credit card debt or struggling to build credit, credit counseling agencies offer expert assistance. They can help you create a budget, manage debt, and negotiate with creditors. In some cases, they can help you enroll in a debt management plan to systematically pay off credit card balances. Credit cards and financial literacy. Understanding the role of credit cards in credit building is a cornerstone of financial literacy. Teaching young adults and students about responsible credit card use sets them up for lifelong success. From understanding interest rates to knowing when to pay the statement balance versus the full balance, every credit card decision impacts your financial footprint. Educating yourself on these fundamentals reduces the risk of falling into debt traps and boosts your financial confidence. Conclusion: making credit cards work for you. Credit cards can either be a powerful ally or a financial pitfall. It all depends on how you use them. When managed properly, they build your credit score, open doors to better financial products, and offer valuable perks. When mismanaged, they lead to high interest payments, debt accumulation, and credit damage. By paying on time, keeping balances low, and understanding your credit report, you can use credit cards as an essential tool in building a strong financial future.